Welcome back to Global Wallet, the podcast where we break down the complex world of finance into everyday language. I'm your host, Alex, and today we're diving into a topic that, believe it or not, directly impacts the price of your morning coffee and the cost of your next vacation, the foreign exchange market, or simply Forex.
And I'm Sarah, here to join the conversation. It's great to be here, Alex. When people hear Forex, they often think of complex trading screens. But as you said, it's so much more fundamental.
Exactly. We've all seen it. You go to buy an imported gadget and the price seems to have crept up from last month. Or maybe you're just tracking the value of your local currency against the dollar. The answer to all those variations lies in Forex. Sarah, let's start with the basics. What exactly is Forex and why is it considered the largest market on the planet?
That's a fantastic question. At its core, Forex is short for foreign exchange. It's simply the place where one country's currency is bought and another's is simultaneously sold. Think of it as a massive, decentralized ecosystem where every banknote is a commodity. It's not a physical building with a closing bell like the New York Stock Exchange. It's a global network of computers.
And the sheer scale is staggering, right?
Absolutely mind-boggling. The daily transaction volume in the Forex market exceeds $7 trillion. That volume surpasses that of the New York Stock Exchange in a single day, moving trillions of dollars 24 hours a day. This makes it the most liquid and accessible market in the world.
Wow. So let's make it real for the listener. Say I'm planning a trip from Peru to the US. When I exchange my Peruvian soles for US dollars, I'm actually participating in this gigantic multi-trillion-dollar market, right?
That's a perfect practical example. When you exchange those soles for dollars, you are interacting with the USD-PEN currency pair. That exchange rate reflects the fundamental principle of Forex. The value of one currency is always measured in relation to another. That's why we always talk about a currency pair in Forex. It's the fundamental unit of trading.
That makes the concept of the currency pair much clearer. But what makes these prices move? Why is the euro sometimes strong against the dollar and other times weak? What are the main driving forces?
The movements are the lifeblood of the market. The price is never static. It's constantly shifting based on supply and demand. The three big drivers are interest rates, inflation, and political stability.
Let's unpack those a bit, starting with interest rates.
Sure, central bank decisions are the main driver here. If, say, the U.S. Federal Reserve, the Fed, raises interest rates, foreign investors are suddenly attracted by the prospect of higher returns on their savings in dollars. This increases the demand for the dollar, and therefore, its value strengthens.
And the opposite happens with high inflation.
Precisely. High and uncontrolled inflation in a country erodes the currency's purchasing power. Investors get nervous and flee from that currency, increasing its supply on the market and decreasing its price.
I see. So who are the big players constantly making these moves? We know about the traveler exchanging money, but who are the major protagonists?
It's a stage with varied participants. First, you have the central banks, like the Fed or the European Central Bank. They are the most influential actors, not trading for profit, but to maintain price stability and economic growth. Their decisions on monetary policy or interest rates can cause massive movements in seconds.
They're the guardians of the currency, essentially.
That's right. Then you have the commercial and investment banks. They facilitate international transactions for their corporate clients, but they also use the market to move huge volumes of capital and speculate for profit. They are the market's engine.
And finally, you have people like me who might use an online broker to trade.
That's the retail trader. Thanks to technology, small investors now have access to this market, which was once exclusive to large banks. The key tool here is leverage.
Leverage? That sounds powerful, but also risky. How does it work?
It's a tool that allows traders to control a large volume of money with relatively small capital. For example, a 100-to-1 leverage means that with just $1,000, you can control a $100,000 position. It's what has made Forex trading hugely popular, but it's a double-edged sword. While it amplifies profits, it also amplifies losses quickly.
Wow. So it sounds like the most important skill in trading isn't predicting the future, but rather risk management.
Absolutely. Setting a stop loss, an automatic order to limit losses, and using an appropriate position size are non negotiable rules for success. The goal is not just to win, but to not lose everything.
Fascinating stuff, Sarah. It truly shows that the Forex market is not just a hobby for traders, but a thermometer of global economic health. Everything is connected.
That's the takeaway. From the price of a simple imported coffee to the value of your long term savings, currency fluctuations directly impact our daily lives. Understanding these fundamental principles is the first step toward financial empowerment.
Well said. Sarah, thank you for guiding us through the essence of the Forex market today.
My pleasure, Alex. I hope it inspires listeners to keep learning.
And to our listeners, if you want to take the next step, remember you can start with a demo account. Practice strategies with virtual money and familiarize yourself with the platform before risking any real capital. Knowledge is the key.